Welcome back, everyone, to another episode here on the Inner Wealth channel. And as you're going through all these foundation videos, just understand that we are going to go down the rabbit hole into a lot of strategies, various strategies. And one of my top favorite ones to utilize, not the only one, but one of my top favorite that I'm currently diving into deeper and deeper as we speak, is correlation. So now, what is correlation? Correlation is, well, let's talk about correlation in the let's talk about correlation in the financial markets. Okay, so correlation in the financial markets is when two assets move together, that percentage of the time in which they are moving together, or inversely, right, in polar opposites, that is what we refer to, that measurement of the time that in which they are in sync is what we refer to as correlation. Okay, so whenever you hear somebody talking about correlation, or inverse correlation, or for example, the most common ones is like the dollar. Oh, have you guys looked at the dollar? Anybody that trades major assets successfully will tell you that they utilize the US dollar. That's the correlation right there, because the US dollar and the major assets all have some level of correlation, right? So, but instead of me explaining all this stuff to you, let me just dive right into it with the charts, all right? Because it makes a lot more sense when you got it right in front of you. So let's dive right into it. Alright guys, so now that we understand what correlation is, we need to learn how to identify it. Okay, and you can identify it by two types. Two types of correlation, which is very simple. There is direct correlation or inverse correlation. What you guys are seeing on the screen currently is what we refer to as inverse correlation. These are two assets that move in opposing direction from one another, but still in relation to one another. Okay, a direct correlation would look something like this. Right? Notice that both the assets, when one moves down, notice my cursor, right? The date's exactly the same. Notice the cursor on the left hand panel and on the right hand panel. Notice how they are on the same date. Okay. Notice how when the one on the right goes down, the one on the left goes down. When the one on the left pulls back, the one on the right pulls back. When the one on the right drops, the one on the left drops. This is what we refer to as a direct correlation. Okay, now as you guys know, Euro USD versus the US dollar have a inverse correlation. Again, look at the cursor. Okay, look at the cursor. The cursor on the left hand side is on the 17th of October, and so it is on the right hand side. Okay, notice when we move up from this low, we move upwards right here on Euro USD, we move downwards here on DXY. When we move upwards here on DXY, we move downwards on Euro USD. That is inverse correlation. Now, in this video, I'm only going to refer to very high quality and strong correlating assets. So any assets that we use as an example here, just know that they are known for their highly correlating statistics. Okay, so when we're looking at correlation, we're gonna divide it into three categories. All right, the three categories are currency versus index, right, which is what you guys see here. Currency pair versus index. Number two, currency pair versus currency pair. Believe it or not, there are pairs out there that just correlate with one another. Yes, they correlate so much that they can give you and support your bias. All right. And number three, it is, you probably guessed it, index versus index. And I will show you guys plenty of examples for both. So yeah, well, you guys can review. And I suggest that everything that you guys see here, back test it right away. Don't just look at this video and then think that you know what correlation is. Go back test this information. Challenge everything that you guys see on this video. All right. So correlation. Euro USD. We're gonna go in the first type, on the first category. Currency pair versus index. All right. So the currency pair that we're gonna utilize is Euro USD, and we're gonna have DXY, known as the US dollar index. Okay, we're gonna utilize these guys. So now again, look at the cursor. When I'm on the left, we're looking at the time. The timeline is at the bottom. That way you guys can see it. So when we're looking at a index or currency pair to index, there are different assets that you can look at, but I will always suggest that you refer to the majors. The majors versus the US dollar are probably the best ways that you guys can test out this theory and this strategy, and you guys can utilize it for yourselves and see for yourselves whether this is something that works or doesn't. So for me, guys, I want you guys to understand the following. I don't personally trade major assets too much. I only touch Euro USD and GU really nowadays. But this is the way that the markets have moved and always moved. This is not a very complex strategy or something difficult to grasp on. You will encounter a lot of difficult strategies, complex theories, and a lot of information that you're going to have to dive into if you want to get the hang of trading. Because there's so much information out there, you have to go through and challenge these things and see for yourself whether they work for you or don't. But this is something that I highly encourage you not to skip. Okay, so Euro USD versus US dollar. Okay, or any major asset, any major currency pair versus the US dollar. You're looking at USD CAD versus the US dollar, that one. You're looking at UJ, which is the US dollar versus the Japanese yen. Okay, UJ has a direct correlation with the dollar. Okay, as UJ's been dropping, right, the dollar's been dropping with it. So UJ, they don't have the best of correlations, right? Because look at this high right here, and look at that high right there on the Japanese yen or UJ, and then over here, the same high over here. Look at the cursor. Okay, so they don't have the best of correlations. You guys will find differences. Now these differences is what we refer to as divergence. This isn't a divergence call, so we're not going to talk about that right now. That will be for a later video. But the difference in a correlation when assets don't correlate is what we could refer to as divergence. All right, but these guys are meant to have a strong direct correlation. All right, so now that is our first category, currency pair versus index. Now we're gonna go to currency pair versus currency pair. All right, and for that we're gonna go back to Euro USD, and I use the futures, so you guys are gonna see that it looks kind of weird or a different name, but this is just the futures. This is still forex. This is still a currency. It's just the future feed of it. All right, and then for the second pair we're gonna go for GBP USD. So Euro USD and GBP USD. Okay, so now why we look at correlating, directly correlating pairs, is because when you look at all of these, you can see these are essentially moving very close to one another, if almost identical sometimes. All right, so now look at the correlation here. We move from September 20th to September 27th. We move downwards, creating a lower low. Then we create a lower high And look at how on Euro USD, I mean on GBP USD, we created that low, and then we created that lower high. We create that lower high to a new lower low. And notice how we create that same lower low over here, right? Then we go from that lower low to a higher high, right? And you guys can see it right there. And it happens over here too. We go from a lower low to a higher high. Boom. Right? And then we go and create a higher low to a higher high. And you guys can see here, higher low and not a higher high. Right? So here we have from this high to this high to a higher high. And over here we have from this high to this what we would call a lower high, right? Because it's a lower high than the previous high. So kind of weird, right? Because these are supposed to be correlated and we should see them move with one another. Now this is the key, guys. This is the type of differences you want to spot in the market. Now, I'm showing you how to identify and categorize and understand correlation. Okay, the difference, remember, the difference between correlating assets, those discrepancies are called divergence. Okay, the discrepancies are called divergence. And this is what we utilize to indicate the end or the start of a trend. Okay, so whenever you identify or divergence, right, whenever you can identify divergence, you can utilize that to either support a long or short bias, or simply to help you stay out of the market when the market is uncorrelated. Maybe it's not as stable as you would like it to be. Maybe that indicates having a bearish divergence, right, will keep you from going long or taking a losing buying position or long position. Maybe some bullish divergence can keep you from taking a losing short position, right? So divergence doesn't necessarily always, every confirmation that we have doesn't necessarily always indicate or lead to an entry. Sometimes it could just lead to avoiding to take extra risk or unnecessary losses, right? So we're going to dive into divergence more on the next slide, but just know that this is what we refer to as bearish divergence. Bearish divergence are identified with the highs. Bullish divergence are identified at the lows. And that's as far as divergence as we need. When you can identify these correlating assets, and let's say you're looking for longs on Euro, but then you see that on the day that you saw those longs, or that you're looking for those longs, we created this divergence on GU. You can anticipate, okay, maybe I'll hold off on the longs or wait for a little bit more evidence on the longs before going into it or taking those long positions, right? So just because we get bearish divergence doesn't necessarily indicate shorts, but it can indicate the longs holding off for a little bit longer, right? So the highs is bearish divergence. Now let's look at the lows. The low here on October 13th. Let's look at it on GU. And then let's go to October 19th. Okay, or let's go to October 26th. So from October 13th to October 26th. Okay, notice that on Euro USD we have been moving higher on the lows. Notice on GU we've been moving lower. This is what we call bullish divergence. So now this bearish divergence, maybe you were waiting for longs, but once you saw the bearish divergence, you stayed out of it because you saw the bearish divergence. And then 1 or 2 days later, you saw this bullish divergence. Now this bullish divergence can indicate the longs that you've been waiting for. All right, guys, so we're going to be diving into the last category, Okay, now the last category, I'm going to use the indices as an example, and the last category is index to index. All right, so now when we're looking at these two index assets, we're going to look for them to trade similarly to one another. Okay, and you guys can utilize these correlations as well in your own studies, but I want you guys to backtest this. Even if you don't trade indices, backtest this. Okay, whenever you're looking at correlating assets, I like to pay attention to major lows and highs. For example, you'll notice that ES or S&P is trading already above its highs, right? NASDAQ is still trading below its highs, right? This is divergence in the correlation. Now, that doesn't mean just because I see bearish divergence doesn't mean I'm just going to short. Okay, don't make that mistake. Don't look for divergence or correlating assets just for pattern's sake. Okay, whenever we're looking at these, you need to have a narrative with it. Okay, write this down. Divergence is a supporting confirmation. Right, it is there to support a already determined narrative or bias. Okay, so when we're looking, let's say we are going long, we did our whole higher time frame analysis, we are super bullish, so I'm going to look for low differences on the lows to support my bullish bias. And the number one thing that you guys can look at is time. Okay, the days. Whenever we sweep lows, do these guys sweep lows, right? So notice something here. Okay, notice something here. This is Friday and this is Monday. Monday, Tuesday, Wednesday, Thursday, Friday. Okay, so on Monday, notice how Monday takes the lows out. Notice how the Monday here doesn't really take out any lows over here, but takes out previous daily low, right? So one thing I'll note is that because this is the low, this Thursday right here is the low of this week, right? Because this whole week starts right here on this Monday. So the lowest point of that week is this Thursday. And notice how Thursday gets taken out by Monday. Now let's come over here. Let's grab Thursday's low and take it to Monday's low. And notice that over here on S&P or ES, we didn't take out that low. Meaning that we left the previous weekly low intact while NASDAQ swept its previous weekly low. That is divergence right there. And when correlating assets diverge, plus having that bullish narrative, this just supports that we're going to have a bullish closing week. Okay, so let's go close these out and let's look at the weekly, and you guys can see that that weekly pumped up, right? Traded into this imbalance, and then here in this one we have an imbalance, but we didn't trade back into it, right? So that's the difference between index versus currency pairs versus currency pairs, and index versus index. They are just different categories of assets and the different ways in which they're used. Now, the indices have a direct correlation, as you guys could see. Some assets like GU and EU will have direct correlation, and some other assets like GU and DXY will have a inverse correlation, meaning that they move with opposing movements. Look at this bullish up close on the dollar and look at this super bearish down close on GU. So inverse correlation versus direct correlation, and then you have your three categories. Plus, you've been given or provided with a lot of super strong correlating markets. Okay, so go back test this information, reach out to me if you guys have any questions, and I will talk to you soon. Peace.